Hey friends, this is Adeal and I welcome you to this live webinar tonight on the 19th of November. And wherever you are, wherever you're watching from, a big warm hello from my side. Please let us know that you are here and leave us a comment, leave us your feedback. Most importantly, leave us your questions because your questions are something that we do these live interactive webinars for. And I will endeavor to answer your questions as we go along. So thank you very much for whoever has joined up until now. And please post your questions. And if you're watching the recording later on, please let us know what your feedback is and what topics you would like us to cover moving forward. So before moving forward, I just wanted to quickly talk about today's topic. So we will be talking about a very debated topic. Should property investors should really be buying brand new properties? And they sound very attractive, they sound pretty logical to some people as well, but I will actually go through some numbers very quickly, whether it really makes sense or not. So uh, leave us your feedback, guys, and your comments as well as you are joining. We are live on LinkedIn, YouTube, and Facebook. And I would just start the slide pack for today. So very quickly, uh, let me just fix it up. Okay. So the topic is, should investors really buy those brand new assets which are flashy, attractive, the promising rental yields and whatnot? So before we move ahead, guys, a quick financial disclaimer like every time. There is no financial, legal, or tax advice provided in today's webinar. Any information or topics which we have discussed today are purely generic in nature and they do not consider your personal circumstances. Some of the information we talk about today may not be even applicable to your situation because we are not across what your personal situation is. So please make sure you seek your independent advice professionally before you act on any information which we are talking about today. So today's topic, should really people be buying brand new assets? And I would just dissect very quickly how property markets have performed in the past 30 years. And I will be dissecting them across units and houses, right? So why I'm doing that, you will get to know very quickly. Now, some of the pros or advantages that they talk about the brand new properties is that they have tax depreciation benefits, which I will delve further into today. They are attractive for tenants, they have brand new fixtures and features, they are easy to rent potentially, that's what they say, and they have less maintenance as well, that's what they talk about in most cases as well. That's the selling point for brand new assets, right? But a lot of cons, a lot of challenges that comes when you buy brand new assets is you're actually paying more for the build on top, which depreciates faster. And I will share you a very quick example for that as well. So you are buying an asset which is depreciating really fast in value. However, you want to buy a property because you want capital growth, you want appreciating assets. So that's very much counterintuitive, right? And it is of course less flexible for improvements, that's what they tell as well. Again, there's a lot of loss in terms of capital growth potential when you're buying brand new properties, because essentially what you buy in brand new is either house rent packages or you're buying off the plan properties in the middle of nowhere in most cases. So that's where you lose a lot of capital growth potential. I've done several videos on that before, so you can go back to the YouTube channel and refer back to them. I will share some comments over here as well, some links for you in the comment section. And of course, if you're looking to build a property portfolio, that's where it really becomes difficult to scale to that next property. If you buy something really brand new in the middle of nowhere just because it attracts people, it really becomes difficult because you are not getting enough capital growth. So these are some of the cons or disadvantages of buying completely brand new assets. But again, there's no blanket approach. In some cases, brand new assets may apply as well, which usually is like some of our clients are overseas investors. So for them, if they buy established property, they pay 3 times the stamp duty, and they can save a lot on stamp duty if they are buying brand new assets. So for them, it's a very easy decision to go for brand new assets, right? Now, what we are talking about here is Sydney price growth between houses and units. And as you can see, there's a big difference of at least around 400, 500K over the last 30 years. Units have grown by $623,000. However, the houses have grown by $1.1 million. This is for the time period from 1992 up until 2022, when Sydney market was pretty much booming until that time, around COVID from 2021, 22, and then it kind of slowed down a little bit. So that's the time period we are talking about, but it's covering a long time horizon of 30 years. So if you see in the last 30 years in Sydney, definitely back in July 92, both units and houses were pretty much at the same price of around 200K. But the way they have grown in the last 30 years, you can see that it's a no-brainer. We need to be going for houses when we are making those purchase decisions, right? That's where the capital growth is. If you look at the overall, I'll move to the next one, the overall capital city scenario. So that's exactly the same as well. 30 years ago, the houses and units in capital cities were even less than $200,000 in their median. But over the next 30 years, the growth has been really phenomenal for houses, more than 900K growth. That is across all the capital cities combined, Brisbane, Melbourne, Perth, Sydney, Hobart, Darwin. We are talking about all of them, the Adelaides as well. And the units have not really performed that well. So there's a big difference in terms of growth that has happened or not happened in case of units. Why I'm telling you this? Now, this is a very important point. If you see over here, the units are pretty much sitting at a median. In 2022, they were sitting at around $636,000, right? So around 600, 650K. That is what the price of units is as the national average we are talking about. Some areas are more expensive. Some areas are a bit more affordable. But we are talking about general market overall, right? Now, what gets sold to a property buyer? So a property buyer is always sold the idea, you buy something brand new, you will get huge tax depreciation benefits. And that's the benefit, the so-called benefit that I really want to delve into without giving you any tax advice. So I will work on a very simple example, and I will break it down for you that whether those tax benefits are really the real benefit, or is it something that is really blown out of proportion, right? So moving further, remember, on average, units can be bought for around 620, 630 nationally, but houses are around 900K, which is much more dearer now. But now what we need to see is that how much growth has happened. As you can see, every year the houses are growing by 16,000 more in terms of value when you compare to the units in Sydney. So every year growth of houses in Sydney Sydney houses has been at least 16 grand higher than the units in Sydney. And once you compare it nationally, so the houses across the nation every year have grown by at least 9 or 10 grand more as compared to the units across the country, right? So that's a simple difference that you can see across each and every year. But everyone knows that, right? No one wants to buy units. People want to buy houses. But now let's assume, can people really afford to buy houses? Well, yes, they can. Now I'm going with a simple example where someone who makes $180,000 income, which is more than the median income of an Australian. But the reason I've picked that number is because around that point, you are paying maximum amount of tax. And a lot of times when you're buying brand new properties, you are sold the idea or the dream that you are getting huge tax depreciation benefits on that brand new asset. That's why specifically I've gone and selected this scenario where I'm looking for someone who's making $180,000, $190,000 in their salary. Let's assume they already property, they already have a family home where they live with their family, which has a loan of 600K still remaining there, which means now they are potentially in a position to build a property portfolio that will help them retire, that will give them the financial freedom that they're really after. But to do that, the borrowing that they are left with now, because they already have a loan, the borrowing they are left with is only between 500K to 700K. So now they can only purchase a property up to around 700K price point given the current interest rates. What does that mean? Should they fall back to units? Well, not really. That's not the answer. In that price point, what essentially a lot of people think of doing is, the first thing they will try to do is, let's try and find a brand new unit and get all the tax depreciation that we can on that unit, right? Now, that's what a lot of people are thinking right now, that probably that's a good investing strategy, because they think buying brand new will give them a lot more rental appeal. They can rent it out easily. They will have a queue of tenants outside of their property, and potentially they think they don't have anything else to buy because that is what they can afford, right? That's what the national price is for the units, around 600K. But having said that, now let's look at the tax benefits that they may potentially get by buying that unit. Now, an average person who's making $180,000 salary as a single income earner in their family, I'm not talking about household income, I'm talking about single income earner over here. So in our scenario, we are talking about single income earners, not family income. So okay, so we are assuming there's only one person who's earning income, and on that income of $180,000, if you put the numbers in the ATO calculator on their website, and that's what I've done, I've gone to the ATO calculator, put those numbers, and I can see that they are essentially paying 51 grand of tax every single year. Now, when you come across those off the plan deals, the dream that you are sold is that you can save on this tax, right? That's the dream that you're sold. Now, let me show you the reality. How much tax do you actually save versus how much capital growth that you actually lose on once you buy something brand new for 600, 700K? Because that brand new thing in 600, 700K is only a unit, right? Let me delve further. Now, once you buy that brand new stuff, let's say for 700K, essentially what you're doing, you're buying a small share of land on a big building where the build value is really high. And the build value can anywhere be around 500K or even around 450 grand. For simple purposes, what I've done is I've gone to the ATO website again, and I've entered that the capital works or the build value is around 500K. If you can see in this slide over here. So I've entered that number in on the ATO website, which you can do as well. And once you put in there, I want to see what my tax depreciation benefit looks like. And once I punch that number of 500 grand in for the capital works or the value of the build for my investment property, that is what actually gives me the depreciation, right? So we want this number high because it's a depreciating number. And once we check how much depreciation we are getting, on average, we are getting a depreciation of anywhere like 12 grand or 13 grand. Now, some depreciation calculators and some companies can front load that as well. Like in the first year, they can make it 18 grand, 19 grand as well. And then it slowly reduces with time. But essentially, on average, as per the ATO website, you can see that the average depreciation is around 12.5 grand every passing year that you own that asset. So if you own it for 10 years, yes, you can claim a depreciation of 12 grand times 10, which is around 120 grand. What does that mean on your tax return bill? Now, if you remember, the tax that you were previously paying was around 51 grand on your income. Now, your taxable income reduces by 12 grand, 13 grand roughly, according to this example. And what that means is that your taxable income is around 167, 168 grand. Now, we are not considering buying under a trust structure. We are simply assuming that you're buying under your personal name, just to keep it simple. There are other tax efficient strategies where you can potentially reduce it, your tax a bit more, but we are just going with the very, very simple scenario. The best thing for you would be to check with your accountant as to how you can save on tax, right? But I'm just trying to compare some scenarios where I'm trying to show you whether tax depreciation really as useful and as attractive as it may sound. So initially you were paying 51 grand. Now with the depreciation of 12, 13 grand every year, all you're still paying around $47,000 of tax. So what you have done is that you have bought an asset which is growing much, much slower, and it's only helping you save around 4 or 5 grand at best every single year on your taxable income, right? So you're getting 4 or 5 grand of tax return, extra tax cashback because of this purchase, which makes you feel really awesome. You feel on top of the world because it's a depreciating asset. But because it's a depreciating asset as well, you are losing out on a lot of capital growth, right? And if I go back and revisit what the capital growth we are talking about, nationally speaking, buying a unit, because you could only afford a unit for under 700K if you are buying brand new as a common buyer, essentially what you're doing is you're losing around 10 grand, 11 grand every year on average. Again, that's the average. In some of the markets we are buying, property prices for houses in that 600, 700K price point are going up by 50, 60, 70 grand every year. So this is all average we are talking about. I'm not talking about some of the regional queens and hotspots we are buying in. I'm not talking about some of the Perth hotspots. I'm not even talking about some of the Melbourne hotspots, which will start becoming hotspot in a couple of years' time potentially. We are not even talking about that. We are talking about national average. And in that national average, essentially what you're doing is you are thank you, Margaret, thanks very much for joining in. Good evening to you as well. It's lovely to see you in these webinars. And guys, please post your questions, leave us your feedback as you watch along. But essentially what you're doing is you're trying to save 3 or 4 grand on tax, but you're losing out at least 10 grand in capital growth, which for me, to be perfectly honest with you, doesn't really make sense. In some of the markets we are buying, that loss can equal to be anywhere between 30 grand up to 60, 70 grand every year. So yes, you will save on tax if you buy a brand new, potentially, but because it's brand new, it will depreciate faster. It will give you a small tax benefit, but because it's depreciating faster, the capital growth loss or the lost opportunity in terms of capital growth is much bigger as compared to that small tax gain. So please try to balance that carefully. Yes, everyone wants to have a cashback at the tax time, but always ask yourself, is it really worth it? Because you are buying something which is depreciating really fast. And that's why your accountants can actually, your property valuers can actually front load for a brand new asset. They can even depreciate $20,000, $25,000 in the first year, which makes you feel awesome. You can probably get 5 or 6 grand back in tax return. But essentially what you're doing is that you are actually buying an asset which you understand that is depreciating faster. So for that asset, I don't think it will allow you to buy more properties faster because it's already depreciating itself. However, you want assets which grow in value. So please be very careful when making a decision. Again, this is not a professional tax advice, but I just wanted to show you some numbers so that you can also compare if you buy brand new versus buying something established in a well-connected area with schools, with hospitals, with healthcare, with more demand, where people want to raise their families, whether that's a good option for you, or buying in the middle of nowhere where you will potentially get schools after 2, 3, 4 years, you will get a hospital after 5 or 10 years, and then slowly you will have capital growth, which will eat a lot of your time frame, because you only have finite time to build a property portfolio. You can't wait for 30 years for that. You have to build it in the first 10 to 15 years, right? That's when you enjoy the fruits of that. So that was my simple analysis, guys. Be very careful. Don't take it as a tax advice again. It is not, but make sure that you are making wise decisions which help you buy future properties faster, and you can make the best use of your money. Now, the next thing would be, if you have any questions, guys, feel free to reach out. This is the QR code if you want to discuss your personal situation which you can't disclose in public. More than happy to have a chat, more than happy to guide you, more than happy to share our strategy as to how we are finding those high growth locations and how we are negotiating and sourcing the right deals for our clients. And we still have spots available before Christmas, because Christmas typically is a very good time to be buying property. If you are delaying your plans to buy after Christmas, let me tell you, you are potentially losing out on a lot of opportunity, because people who really want to sell before Christmas, they are preparing their properties to sell today, and they want to sell before Christmas, which means if you park and you don't do anything before Christmas and you wait for the New Year's, potentially a lot of opportunities will be there which you can miss out on, and a lot of good bargains can be missed as well, because some people are constrained. Some sellers are really constrained with time. They want to sell before the Christmas. They don't want to drag their sale into the new year. A lot of real estate agents also want to get rid of some of the stock on their books before the year finishes, so that they can start fresh in the new year after the Australia Day, right? So please, if you are delaying your plans for buying property, whether you want to do it on your own or whether you want to do it with someone, try and take action now, because you can get some good bargains, some good deals potentially out there. Until next week, stay safe, stay happy. Send us your questions in the comments if you watch this recording, and I will catch you next week. Until then, take care.